Are you ready to build a passive income stream or securing your financial future? Whether you're completely new to dividend investing or just curious about how it works, this video is the perfect place to begin. I will guide you through the essentials of dividend investing, the key steps, and what you need to know before putting your money in. Let's dive in. Let me clarify what dividend investing is. When you purchase shares of dividend-paying company, you become a partial owner of that business. This entitles you to be a portion of the company's profits, which are paid out as dividends. Companies typically pay dividends on a regular schedule, often quarterly. This is the great way for investors to earn passive income, regardless of the stock price at any given moment. What makes dividends attractive is the idea of long-term passive income. As you hold onto dividends-paying stocks, the income continues to flow in. On top of that, some companies increase their dividends over time, which means your income grows as well. Why should you consider dividend investing as a strategy? Unlike other forms of investing, where your profits are solely tied to the stock prices, dividends investing lets you earn money in two ways. The first step is through the dividends themselves. There are the regular cash payments from the company. Number two, potential price appreciation. If the company's stock goes up, your investment grows in value. But here's the thing, you don't need the stock to increase in price to make money with dividends. Even if the stock prices remain flat, those dividend payments keep coming in. That's the beauty of it. Consistent income. That's not as dependent on market fluctuations. Dividends are great for compounding wealth over time, which we will dive into shortly. Before you get started, it is essential to understand few key terms in the world of dividends investing. Let me break it down for you. Step number 1, dividend yield. This is one of the most important metrics to evaluate dividend-paying stocks. The dividend yield is calculated by taking the annual dividend payment per year and dividing it by the stock's price. For example, if a stock costs $100 and pays $5 in dividends per year, the yield is 5%. High dividend yields can seem attractive, but be curious. Sometimes high yield could signal trouble, such as declining stock prices. Step number 2, payout ratio. This tells you how much of the company's earnings are paid out as dividends. A healthy payout ratio is usually below 60%. If the payout ratio is too high, say over 80%, it could indicate the company is paying out most of its profits, which could become unsustainable. Profits decline. Number 3, dividend aristocrats. These are the companies that have increased their dividends for at least 25 consecutive years. They are considered to be stable and reliable for incoming investors. Example include companies like Procter & Gamble, Johnson & Johnson, Coca-Cola. Investing in dividends aristocrats is a popular strategy for those seeking dependent long-term. Now that you understand the basics, let's walk through how you can get started with dividends investing today. Step number 1, open a brokerage account. You will need a brokerage account to start buying dividend stocks. Some popular platforms include Vanguard, Fidelity, Robinhood, and much more. Look for a broker that offers low or no fees, as they can eat into your returns over time. Also, check if the broker allows dividend reinvestment programs, which automatically invest your dividend to buy more shares. Step number 2, research dividend-paying stocks. Look for companies with solid history or paying and increasing their dividends. Focus on large, established companies that have a history of stable earnings. Even during downturns, resources like Yahoo Finance, Seeking Alpha, and dividend stock screeners can help you find potential investments. Remember, Past performance doesn't guarantee future results, but a long history of dividends payment and increases is a good sign. Step number 3. Start small. You don't need a large sum of money to start. Many brokers offer fractional shares, meaning you can invest in a portion of a stock for as little as $1 or to $5. This allows you to build a portfolio over time without needing thousands of dollars upfront. Step number 4. Diversify your portfolio. Diversification is the key to reducing risk. Instead of putting all your money in one stock, spread your investment across different sectors, such as consumer goods, utilities, and healthcare. This way, if one industry faces challenges and others can provide stability, a good goal for beginner is to aim for 8 to 12 different individual paying stocks to build a solid base. One of the most powerful strategies in dividend investing is reinvesting your dividends. Rather than taking your dividends as cash, you can reinvest them to buy more shares of stocks. This leads to the magic of compound growth. Over time, the compounding effect can significantly accelerate the growth of your portfolio. Let me give you an example. Imagine you invest $1,000 in a stock with a 5% dividend yield. If you reinvest those dividends every year and the company continues paying you same dividend, your original $1,000 investment will be worth much more after 20 to 30 years due to the power of compounding. Of course, like all investing strategies, dividends investing come with some risk. Here are the few things you need to keep in mind. Number 1, dividend cuts. Companies can reduce or eliminate their dividends during tough financial times. For example, during a recession, companies might prioritize saving cash over paying shareholders. Number 2, stock volatility. Even though dividends provide income, the underlying stock can still fluctuate in value. This is why it is important to look for quality companies with strong financials. Number 3, chasing high yields. Be careful not to chase the highest yield stock blindly. Sometimes, a high dividend yield is a warning sign that the company is struggling and dividend might not be sustainable. Always look into companies' fundamentals. Dividend investing is a powerful way to build wealth and create a passive income stream over time. The key is to be patient, diversify your portfolio, and focus on high-quality companies. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss out on future investing tips. Drop a comment below if you have any question or want to share your favorite dividend stock.